YouTube, what's going on? My name's Gabe Bowling and welcome back to another video. In today's video, we're going to be going over, is now a great time to invest in multifamily real estate with all of the madness and insanity going on in the markets today? The biggest question I get is now a great time to get into the market? Should I be waiting? I'm sitting on the sidelines with cash. I just don't know what to do. And so by the end of the video, you're gonna know why I believe buying in today's environment is so much more attractive and actually friendlier on your side today than it was over the last 2 years. And more importantly, by the end of the video, you're gonna have my 3 rules that I have for any new deals today to make sure that I'm protecting myself and more importantly, the investors that are involved in these deals as well. So make sure you stick around for the entire video and let's go ahead and let's jump in. So the biggest question is, why is it such a good time to get involved in real estate opposed to what you're hearing on the media and what narrative you're actually being told? You're probably seeing bank failures going on. You're seeing all of the uncertainty in the market, basically saying you shouldn't do anything. You should be scared and you should be on pause while everything is happening, right? Absolutely not. I'm telling you right now, there's better opportunities today in the marketplace than there has been in the last 5 years, even 10 years, specifically for the multifamily space. And so you have to be careful with where you're getting your information and who you're getting it from. When you listen to the most successful investors that exist, not only in real estate, but overall investors like Warren Buffett, he has a famous saying that says, when the tide goes out, you'll really see who's been swimming naked. And it couldn't be any more true today. So yes, is there a ton of uncertainty going on? And yes, is there a ton of possibility that real estate owners can lose their money and lose their properties going into the next 24 months? Absolutely. And so if you're an owner of a property, it's not going to be the same story if you own the properties. And so let's be very clear. I'm specifically talking about new acquisitions from today on over the next 2 years for the investor that's just getting into the business or for the investor that already has an established business and can take advantage of these opportunities as they come up. You have to be prepared for it. And so you have to ask yourself, why is all of this stuff going on? Why is there distress in the marketplace? And why do you see everybody left and right talking about how much opportunity there is in the marketplace? So just to break it down very simply, all that's really happened over the last 12 months is interest rates went through the roof. It's no secret that Jerome Powell has been absolutely crazy with the amount of rate hikes that's happened over the last 12 months to try to tame all of the inflation happening. And so I want to take a simple explanation and show you exactly what happens to real estate values and why some of the people who bought in the last 24 months are going to be the first ones that feel it and take the hits. So I'm going to give you an example of a made up property. And let's say that this property has a net operating income or an NOI of $100,000. Since 2020, when interest rates basically went to zero and everything was free, let's just keep it simple and say that the average deal sold for a 4.5% cap rate. That means over the last 2 years, a property that has $100,000 of NOI, all you're gonna do to figure out the purchase price that somebody would have paid over the last 2 years is divide it by 0.045 and take 100 grand and divide it by a 4.5 cap. All you're gonna do is you're gonna take the 100 grand, you're gonna divide it by 0.045. That person paid $2.2 million for that exact same asset over the last 2 years. And today, because of the way that interest rates went up so quickly, investors like myself and you can only afford to, let's just say you can pay a 6% cap rate. So if you take the same $100,000 of NOI and you just simply change the cap rate that you can pay for it from 4.5 to a 0.06, you can now only pay $1.6 million for the exact same property in the same location with the same net operating income, and that big of a change in value going from 2.2 to 1.6 literally in the last 10 months is why everything is happening today. And so what's that mean? Opportunity. You can buy deals for literally 30% less today than you could 10 months ago. That's some of the very basic, simple math. Hopefully you were able to take away the biggest difference between basically all interest rates. They went from 3% to 6%, and now the buyers can only afford to pay so much. And so that leads into the next reason of why it's such a good time to jump into the market today, even as a new buyer or an existing company taking advantage of a new acquisition. There's this stress all over the marketplace, more now than ever, especially over the last 10 months. It looks like we're on the tail end of the interest rate hikes. And so it points to more stability in the market, and sellers are now finally accepting the fact that their values aren't where they were 10 months ago. All I mean when I say that there's a stress in the marketplace, the purchaser that bought a deal in the last 12 to 24 months probably used what's called a bridge loan, or it's basically the equivalent of hard money in the single family space, right? You got expensive debt on a floating adjustable rate, and it's a shorter term loan, 1 year, 2 year, 3 year loans, where now because interest rate expenses have gone through the roof, they're running into two issues. Either they can't service the debt because the interest expense, the payment itself, has either doubled or tripled in some cases, or they just ran out of time, which means their maturity date is coming up and the value of their property isn't where they thought it would be, and they're upside down in the deal. So you take the two, you have a bunch of distress in the marketplace, and you have interest rates all over the place. All of this mixed together is really all of the ingredients for a perfect opportunity. And so now that we went through all of the reasons of why it's a great time to get started investing, you do have to be very real with yourself and ask yourself, okay, are we going into the marketplace with choppy waters? Is it a normal cycle? Or are we coming off of the height of the cycle that we've been in the last 3 years? Understanding how to navigate the waters has never been more important today than any time in the last 10 years, because it's been going constantly up, 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 and now we're starting to enter a new cycle. And so the 3 rules that I was talking about at the very beginning of the video are the 3 rules that I have to have on all the deals that I'm submitting offers on, which the first one is positive leverage. By following this rule, it's going to keep you out of a lot of trouble. You're going to be cash flowing positive, and hopefully you bought yourself some time and you're going to be good. So positive leverage is just making sure that the interest rate that you're borrowing the loan at is less than the cap rate at which you're paying for. So to give you an example, let's say I buy a deal at a 6% cap rate, meaning let's say it's $1 million and it's a 6% cap rate, meaning the NOI, the net operating income, is $60,000. Now that same $1 million property, I'm gonna go out and I'm gonna borrow $650,000 to $700,000 to buy that property. If that interest rate exceeds 6%, which is the cap rate, then technically I am negatively leveraged. There's no positive. Now, if I borrow that money at 5.5% and my cap rate is 6, that means I am 50 basis points or half a point positively leveraged. That is a good thing. That is my internal rule that I have to check the box to make sure that I'm covered as a buyer. So it's really important. Number 2, the upside or the projected business plan. This is where all of your money is made in this business. And so you have to understand, you have to be very accurate when it comes to projecting upside. For me personally today, especially in Florida, guys, we just came off of one of the largest rent increases that we've ever seen in history. For the last 2 years, it's been consecutively 15 to 20% per year. So total, these rents have gone from $1,500 to $2,000, or from $2,000 to $3,000 over a 2-year period. And so you want to be careful with how you're projecting rent growth in the future. For me, I want to give you a very conservative baseline. I underwrite deals into the future with no rent growth other than what's proven either on the rent roll today or proven in the marketplace. Meaning if I don't do a single thing to that unit, what is the maximum amount of rent that I'll be able to get? And then if I do something to that unit today, what does the market suggest that I can get? I'm not hoping that the market can go up another $100 or $200, even $300 like some of these other people will do. So you have to be very comfortable with your upside, especially in growth markets that have seen tremendous amounts of growth over the last 24 months. And then lastly, and this is by far the most important one, don't do short-term stuff, meaning you want to buy yourself enough time on your loans. So for me personally on the debt, I'm looking for fixed rates only between 5, 7, and 10 years long, meaning the soonest I have to sell, meaning a balloon payment, is 5 years from now. I do not want to have to force myself into a 1-year or 2-year loan, because the only way that you lose money in real estate is by either you can't service the debt, a bunch of bridge borrowers are going through that right this second, or you run out of time. The same thing on the people that are in short-term loans. They ran into both problems. They can't service the debt and they ran out of time. So if you have enough time on your side, you're cash flow positive, there's no way that you can lose money. And so those are the 3 rules that I have. If I'm positively leveraged, that means I'm good on my cash flow and I'm gonna be positive cash flow. If I'm in a good location and I'm basing my upside, my projected business plan on what's proven today, and I can buy myself another 5, 7, or 10 years, I love the deal. And so that's how you protect yourself as an investor going into choppy waters like we're going into. You have to take a step back, look at it from this angle. The properties that I'm seeing today are literally valued 30 to 40% less than they were in the last 12 to 24 months. Think about that. Nothing has changed to the property. Still in a great location, still with great tenants, still with great upside potential, but it's 30% less of the value today than it was in the last 24 months. So if you can hit your projected business plan today on a very conservative exit, just think about what could happen if rates do go back down over the next 5, 7, 10 years from now. Think about how much extra upside you're gonna capture just because of the timing that you entered the market. And so if you wanna learn more about multifamily and how to get started, I have a completely free 2-hour-long course. Literally, it's 9 chapters, 44 segments, completely free. All you have to do is just click the link in the description, put your email in, and you'll receive immediate access. And with that being said, make sure you guys subscribe, like, more importantly, comment below with the type of content that you want to see, whether it's specifically to multifamily or just in real estate in general. We're going to be bringing a lot of content on a weekly basis here, and I want to make sure that you get the most out of it. So I look forward to hearing what you guys have to say, and I'll see you guys next time.